Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. According to many analysts and investors, 2024 was supposed to be the year of the small cap. Mind you, 2023 was as well. But here we are in September and small caps are still broadly underperforming, with our largest companies, the banks in particular, the standout performers on the local bourse. I wanted to take a look at what it means for investors and whether there are some opportunities now out there in the small cap space. Andrew Peros is the co-portfolio manager of the Ausbil MicroCap and SmallCap funds. Ausbil Investment Management is an Australian investment manager with more than $16.6 billion in active Australian and global equity investments. Andrew, welcome to Fear and Greed.
Hello, Sean. Thank you for having me.
I want to talk about the future, but before we get there, I'd like your take on the reporting season that we've just had, finished a couple of weeks ago. What did you make of it?
Well, reporting season is a great time for us here at Ausbil. As a small cap investor, we're very much bottom up and fundamental stock pickers. And what better time to prove out that process than reporting season, when we get to see the company's reports and effectively get our report card to see if we have been picking those companies which are in upgrade mode and clearly avoiding the bombs that are in downgrade mode. Mm-hmm. You know, it has been in the past a very lucrative time for alpha generation from our perspective. That said, the August reporting season that just passed was actually quite challenging, probably one of the more challenging reporting seasons we've had in a very long time. And that is mainly because, number one, there were a lot of bombs throughout reporting season, but more specifically, in aggregate, industrial stocks throughout reporting season downgraded their numbers by approximately 8%, whereas in the past, we normally see downgrades of 1 to 2%. So, as I said, there were plenty of landmines out there. It was very tricky. 18 stocks were up 10% or more on the day of their result. But perhaps more importantly, there were 35 stocks which were down more than 10%. And then maybe just taking that one step further, there were 7 stocks which totally bombed out, down more than 20%. So, you know, the likes of Audinate, Johns Lyng, Tabcorp, Kelsey, and PWR Holdings, just to name a few.
Okay, was there a theme about why there was an underperformance in the industrials? Was it a cost story? Was it a revenue story? Or there wasn't anything broad enough to put it in those sorts of terms?
No, nothing specifically, but, you know, the downgrades or the weakness was across the entire spectrum of the P&L. We did see some softness at the top line. There were a lot of cost pressures. I mean, there's been talk of inflation being a lot stickier than anticipated, so costs were slightly elevated, which flowed through down to the NPAT line.
Okay, so let's look at, you were talking small caps and micro caps, so actually maybe I'm better for you to define what a small cap is in Ausbil's world and what a micro cap is, and then I really want to get into why they have underperformed for so long.
Yeah, well, we see a small cap as a company that fits within the Small Ordinaries Index. I also co-manage the Ausbil MicroCap Fund, and it's more of an ASX 200 microcap fund, but we really target those stocks in the ASX 300 to 200. We call that the sweet spot, and the emerging companies that may eventually progress into the ASX 200.
Right, so that's the micro cap, and the small caps are more the sort of 100 to 200 or even 50
Correct.
to 200.
Yeah.
Okay, so why have small caps underperformed for the past couple of years, particularly given valuations? Because, you know, relative to large caps, on a historical basis, they look cheap.
Well, a lot of us small cap managers have really been calling this the year of small caps. And Sean, it is a great question that you're asking, because we do get asked that quite a lot. From the outset, I will say that there are still many opportunities, or huge opportunities, in the small cap market, and significant alpha to be generated if you look hard enough and if you work hard enough to find those. But I guess, you know, your broad question around small caps underperformance is more in the context of relative to large caps. So if I use round numbers, the Small Ordinaries Index is down 1% this calendar year to date. Large caps are actually up 6% this calendar year to date. But if we take a step back and look under the hood, you know, there's a vastly different story to be told. You know, and if I was to segment the small cap market into 2 buckets, resources and industrials, the small cap resource market has actually been quite weak. So small cap resources down 12% this calendar year to date, whereas small cap industrials are up 6%, which is more akin to the performance that we've seen in large caps. But I guess when we're comparing the two on a relative basis, it's good to understand what's driving the performance in large caps as well. And you did call that out, Sean, from the outset, that it really is a story around banks in large caps. I was looking at the large cap bank index more recently. That's up 27% this calendar year to date, which is quite unbelievable. I had to double take when I saw that. Commonwealth Bank, for example, up 25% or about 25% this calendar year to date. Westpac up a whopping 40%. Now, those numbers are quite unheard of. You very rarely, if ever, see that kind of performance in the Aussie bank market. But I guess, what I'm trying to say here is that, the opportunities are there. You've just got to go hunting for them.
Stay with me, Andrew. We'll be back in a minute. I'm speaking to Andrew Peros, co-portfolio manager of the Ausbil MicroCap and SmallCap funds. Okay, Andrew, so we might just park resources at the moment because so much of that is based on commodity prices. Industrials, though. So in your small cap index, what are some of the industrial, name a couple of industrial companies, or maybe they're consumer discretionary, retailers, that sort of thing, which you like at the moment?
Yeah, well, it's probably worth calling out, some of our larger positions in the portfolio. Roughly, our top 10 stocks account for half the portfolio. The top 20 account for about 70% of the portfolio. So we do run a very concentrated portfolio,
right?
Averaging, anywhere between 35 and 40 stocks. But some of the key names in the portfolio, the key contributors, Life 360, a stock which is up 120% this calendar year to date. Guzman and Gomez, a recent addition into the portfolio. Codan, a company which we're familiar with, we did own in the past, and we have revisited that name and has been a strong contributor. Pinnacle, Pro Medicus. Unfortunately, we had to recently exit the Pro Medicus position now that it's firmly in the ASX 100, so out of index.
It's disappointing, but it's kind of a good reason to have to get out of it.
Yeah, we never like to see our favourite children flee the nest, but unfortunately that's the reality of life. Zip, again, a relatively new position in the fund, and Light & Wonder, rock solid, key contributor to this year's performance as well.
You mentioned Pinnacle then, and you said you were in it, then got out, and then came back in.
Codan, yeah.
That was Codan. Sorry. So in that particular instance, and Codan's a kind of communications, metal detection,
correct,
mining tech company, yeah. So how hard is it to get out and in mentally? It's not physically hard to do that, but if you've got a company, it's almost, it's easier to buy, hard to sell, I suppose. So how do you overcome that?
Yeah, we're very unemotive with the way we think about stocks. We have a process which we follow. The Ausbil process is tried and tested over many years. There was a period of time when Codan didn't fit within the Ausbil process, but it has come back on the radar. And look, for us, they're just numbers on a screen. If the numbers add up, then we'll certainly revisit it. If they don't, we will exit a position.
And so that process, just give us a very thumbnail sketch of that.
So we look for quality. Quality is one of the key characteristics we look for in stocks. And when we think about quality, we think about, a quality management team, a management team that has skin in the game. We look for accessible earnings, so a company that we can model out, build a full P&L, cash flow, balance sheet. We want to assess the earnings and subsequently value those earnings or those cash streams. We look for capital-light businesses, generating a high return on invested capital. But perhaps most importantly, in small caps, we're looking for those that have undergeared balance sheets, a very low net debt to EBITDA ratio. It's critical in small caps. We've seen so many instances where small cap companies have been caught on the wrong side of having or carrying too much debt at the wrong time in a cycle.
Okay, so you named a bunch of companies there. Any sort of one or two of those that you are particularly keen, or they're in your portfolio? Are there ones outside your portfolio that you're looking at, or any of those that you mentioned that you're particularly keen on?
Yeah, Zip is a relatively new position in the portfolio and something that we're quite constructive on. We initiated a position at around $1.52 when the company raised capital to pay down some expensive debt, and that was a highly accretive transaction. The cost of equity clearly much cheaper than the cost of debt. So it's been a great investment so far, up 50% or thereabouts since that initial investment. But, Zip, a clear number 2 buy now, pay later business in the ANZ market, a very strong position in North America. The company has been transformed under the stewardship of a very exceptional CEO, Cynthia Scott. She's quite outstanding and has been instrumental in turning the business around from the period where free money was readily available and they were targeting growth at any cost. And now it's more a function of profitable growth and sustainable growth. And, despite tightening the metrics within the business, on our numbers, we can see a scenario where the top line is growing anywhere between 25 and 30% over the next couple of years, and you're getting EBITDA growth of 80 to 90%. So firmly within an upgrade cycle, and at least on our numbers, we think they're going to beat consensus markets forecast. So that's why we like it.
Fantastic, Andrew. Thank you for talking to Fear and Greed.
Thank you for having me, Sean. It's been a pleasure.
That was Andrew Peros, co-portfolio manager of the Ausbil MicroCap and SmallCap funds. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.